Hi, I'm Bill Walker. Small is risky, large is safe. When it comes to picking equities, is this a myth or a reality in today's market? Here to provide his thoughts on the subject and the state of small cap equities in general is Rob Mikalachki, head of small cap equities for Trimark. Rob and his team are also the winner of the 2012 Lipper Award in the U.S. Small Mid-Cap Equity category for Trimark U.S. Small Companies class over a 3-year period. Rob, this whole notion of small is risky, large is safe. How do you respond to that?
I absolutely reject that notion. And perhaps you can make the case that the percentage of failures are higher amongst smaller companies than they are amongst larger companies, but that's not the right way to look at it. You know, the perspective that I adopt is if you're constructing a portfolio of 20 to 30 unique businesses, where do you want to look and what are you looking for? And in particular, we're looking for companies that absolutely dominate their turf. We're looking for businesses that are in growing industries, and we're looking for companies that are underfollowed or underappreciated by the market. So where are you going to find that? You know, certainly you have larger companies that are entrenched and doing very well, but many of them have exhausted their growth. And if they haven't, it's probably not a secret to the investment masses. So for us, we find bigger bang for our buck at the smaller end of the spectrum, and we think we can do it with less risk. And I'll give you a great example of a business we own in all of our small companies funds. It's a company called Synaptics, and they're the world leader in touch technology for electronics. So when we first made our investment in Synaptics a couple of years ago, their dominant business, where they really owned the industry, was in touchpads for laptops. They had 60 to 70% global share of that turf. But they were exporting that technology into adjacent industries. They gave Apple the click wheel for the iPod. They gave Apple the touch technology for the first iPhone that went out there. And as you see smartphones and tablets and other devices proliferate, they're doing so with our technology. So you have this business that dominates its turf, that's growing, and at the time we bought it was trading for about 7 to 8 times earnings if you backed out the cash on the balance sheet. So just a wonderful, wonderful business. And if you can put together a portfolio of 20 to 30 of those companies, I think you're really lessening the risk. And the proof is in the pudding. If you look at our funds, I don't care what your measure of risk is. If it's volatility, standard deviation, up, down capture, or the way I define it, losing money, we compare very favorably to the large cap companies, oftentimes more favorably to the large cap funds that are out there.
Well, that's a great overview of your philosophy. So then you get asked the next question, which is, what is your outlook on 2012, and how do you respond to that?
I generally respond just by looking the other way. It's not a question I'm comfortable answering. I think it's a bit of a fruitless endeavor, and to think that you have some sort of financial clairvoyance, I mean, I think that's a dangerous sense of confidence to have. So I don't spend a lot of time prognosticating. What I focus my effort and my brain power on is looking for these companies with some sort of meaningful and enduring point of differentiation. Looking for companies with somebody with high moral standards minding the store and then trying to get them at a big discount.
It sounds like there's a lot of due diligence and a lot of research that goes on. You know, advisors and investors are really still predominantly steering clear of equities because of the volatility in the markets, but you're not. So is this the type of really diligent work that you have to do? How are you different when it comes to buying stock?
I think our time horizon is different. And volatility, it literally is a 4-letter word in investing, because in investorese, it's risk. And when people find themselves in this sea of volatility, you know, their chest tightens, their breath becomes tighter, and they start investing with their heart instead of their head. And again, for us, we adopt a longer time horizon. I could care less about what the next 6, 12, or 18 months brings for any of my businesses, but I know if I can find these companies that are, uniquely and permanently differentiated, eventually I'll be rewarded for those decisions.
And finally, we get a lot of questions from advisors on behalf of their clients, and they always say, is there one insight that we could get from an expert like Rob, one insight that they could take away from, say, today's conversation? What would that be?
Self-awareness. Investors, big and small, have a very rich history of getting in their own way, and doing the wrong thing at the wrong time. If everybody could just pause, take a breath, and reflect on their history of investing, I think they'd be able to identify where they've made mistakes along the way. And if you're just aware of what your biases are, that's the biggest step in overcoming them.
All right, thanks for doing this.
Thanks a lot, Bill.